So after the company purchases its plant asset, it starts to use it, and as it is using the plant assets, this plant asset starts to depreciate. That's why the company usually needs to calculate the depreciation of the plant asset. The explanation can be found from page 9 to page 23 in your books. The depreciation is the process of distributing the cost of the plant asset over the useful life or the estimated useful life of the plant asset, and that is the number of years that the company expects to use the plant asset. We have three different methods to calculate the depreciation, and it is the straight line method, the units of activity, and the double declining balance method. Three factors usually affect this depreciation, and that is the cost of the plant asset, the salvage value, or what we also call the residual or scrap value, which is the value of the plant asset at the end of the plant asset's useful life. And we have the useful life also affects the depreciation of the plant asset. We will start with the straight line method, and it's found on page 10. We usually have 4 different steps in order to calculate this depreciation, and the first step is the depreciable cost, and it's the cost minus salvage value. After that, we need to calculate the annual depreciation expense, which is the depreciable cost, which is found on step 1, divided by the useful life, of course in years. After that, we need to calculate the accumulated depreciation for each year, and it's calculated by the accumulated depreciation at the beginning of the year plus the depreciation expense occurred in this year. And step 4, we have the book value, which is the cost minus the accumulated depreciation at year end. We have an example on page 10. In this example, the company purchased an equipment for $100,000 on January 1. It's expected to have a 5 years useful life and salvage value of $10,000. So the first step, the company needs to calculate the depreciable cost, which is the cost minus salvage value. We have $90,000. So $90,000 will be depreciated over the 5 years. Here we come to the annual depreciation expense. So the total amount that will be depreciated is $90,000, and we are going to distribute it to the number of years that this plant asset will be used, and in this exercise it's 5 years. So 90,000 divided by 5, it's 18,000 per year. So now we can calculate accumulated depreciation at year end for each year. So accumulated depreciation for the year end 2017, it's 0, since it's the accumulated depreciation at the year start. Why it's 0 at the beginning of the year? Because we just purchased the machine or just purchased the equipment. So at the beginning of the first year, the plant asset does not have any accumulated depreciation, so it will be 0, plus the depreciation of the current year, which is $18,000. The next year, at the end of 2018, the company will have an accumulated of $18,000 plus the 18 of this year, so we will have a total amount of $36,000. At the end of 2019, the total accumulated depreciation expense is $36,000 plus the $18,000 of this year, and it will go till the company finish its useful life, which is after 5 years, and that is in the year 2021. And the total accumulated depreciation will be equal to the depreciable cost, and that's the case for all the 3 different methods. The last step is to calculate the book value. The book value is the cost minus accumulated depreciation at year end. We need to calculate it for the 5 years. At 2021, which is the end of the plant asset useful life, always the book value will be equal to the salvage value of the plant asset. Here we have the entries for the adjusting entries. Please open your book on page 12, and here we have an exercise and its solution. Now we have the same given for the exercise found on page 15, but the only difference is that the company, instead of purchasing the truck on January 1, 2017, it purchased it on October 1, 2017. The cost is the same, 18,000, salvage value 2,000, useful life 4 years. The first step, it is we need to calculate the depreciable cost, which is the cost minus salvage value. We have a $16,000. The annual depreciation expense, it's still $4,000 per year. But we need to pay attention that in 2017, we did not use the truck for 1 year, which is the annual. So actually the depreciation expense for 2017 is not $4,000, but it is the $4,000 times the number of months that we use, and that is October, November, and December. So we have $4,000 times 3 months used over 12. So we can say that in 2017 the truck was depreciated by $1,000. From December 31, 2017 till 2018, we have a full year, so it's $4,000. 2019, $4,000. 2020, $4,000. But in 2021, we did not use it a whole year, but we use it till October 1, 2021. So we actually use it January, February, March, April, May, June, July, August, and September. So from the year of 2021, we only used the truck for 9 months. So we cannot say that it was depreciated by 4,000, but it was depreciated by 4,000 times 9 over 12, which is $3,000. So the depreciation schedule will be, if we look here, we have 2017, 18, 19, 20, and 21. That doesn't mean that the company used the truck for 4 years, but it used it for 4 years, 3 months from 2017 and 9 months from 2021. The units of activity, which is another method, the explanation is found on page 17. The steps are very close to each other. First, we need to calculate the depreciable cost. Then we need to calculate something called the depreciable cost per unit, which is the depreciable cost divided by the total units of activity. So the main difference is that in the first method, which is the straight line, the company was relying on the useful life, the number of years. But here in the units of activity, the company is relying on the total units of activity, which will be given with you. So the depreciation expense in this case will be the depreciable cost per unit times the actual units of activity which is given. After that, we calculate the accumulated and the book value in the same way as we used to calculate in the straight. So here we have an example which is found on page 17. Here the company purchased an equipment for $100,000. The salvage value is $10,000, and it's expected to be used for 4 years, and the activity level here is given. For example, in 2017 the company will use the equipment for 36,000 hours. In 2020 it will use it for 18,000 hours. The first step is depreciable cost. We have it $90,000. This amount is divided by the total activity level, which is 180,000 hours. We got this number by adding the 36,000, 72,000, 54,000, and $18,000. So the depreciable cost per unit will be $0.5 per hour. Now we can calculate the depreciation expense, as you can see here. So this is the schedule. We have the units of activity which is given, the depreciable cost per unit which is fixed for all the years. After that, we calculate the depreciation expense. The accumulated depreciation will be 0 plus 18. Next year will be the 18 plus 36. After that, 54 plus 27, 81 plus 9. The book value is the cost minus accumulated depreciation. And here we have the exercise, the solution for the exercise on page 19. Now about the declining balance method, which the explanation is found on page 20. We have the different steps. We have the double declining balance depreciation rate, which is always 2 times 100% over the estimated useful life. This rate is then multiplied by the book value of the plant asset at year start. After that, we can calculate the accumulated depreciation at the book value in the same way as we were calculating in the two previous methods. We have an example on page 20. The company purchased an equipment in 2017 for $100,000. The salvage value $10,000 and the useful life is 5 years. If we need to calculate the double declining balance depreciation rate, it will be the 2 times 100 over useful life, and that is a 40%. So we start with the book value at year start. On 2017, we had just purchased the equipment, so the book value will be equal to the cost. After that, we have the depreciation rate. Now we can calculate the depreciation expense. So it will be the 100,000 times 0.4, 40,000. We can calculate the accumulated depreciation. Based on that, we can calculate the book value at year end. At year end 2017, the book value is $60,000. This amount we will carry it for the book value at year start, because the end of 2017 is always the beginning of 2018. So now we have the depreciation rate, which is 40%. To calculate the depreciation expense, we have 60,000 times the 40%, so we have 24. Accumulated depreciation 40 plus 24, 64. The book value will be the cost, which is 100,000 minus 64,000. We have $36,000. The book value at year end 2018, it's the beginning of 2019, and so on. But please pay attention when you reach the end year, which is 2021, the depreciation expense cannot be calculated by multiplying the book value at year start times the depreciation rate, but you need to pay attention that it is equal to the 12,960, which is the book value at year start, minus the salvage value, which is $10,000 in this case. So we have $2,000, $2,960. And here we have an exercise, the solution for the exercise found on page 23.